It's 12:47 a.m. You're half asleep, scrolling real estate listings, telling yourself you're just looking. Every house under $400,000 looks like it survived 3 divorces and a small fire. Every house that looks remotely livable, $500,000 minimum. Laminate countertops, beige carpet, a basement pretending to be wood-paneled. And the listing calls it a starter home. You start doing the math in your head. Your salary, your savings, your future raises that don't exist yet. And that quiet thought creeps in. Did I miss something? Or did the housing market completely lose its mind? It's not you. It's the math. Welcome to Capital Misfires. My name's Jimmy, and today we're doing something real estate agents absolutely hate. We're not asking, can you get approved for a $500,000 house? We're asking the much scarier question, who can actually afford one in 2026 without turning their life into a financial stress experiment? Because qualifying for a mortgage and being able to live with that mortgage are two very different things, and confusing the two is how people quietly ruin a decade of their lives. Let's ground this in reality. In dozens of U.S. markets right now, $500,000 isn't luxury, it's baseline. That gets you around 1,200 square feet, 3 bedrooms, 2 bathrooms, a yard the size of a bath towel. In places like Denver, Austin, Phoenix, or anywhere near a major metro, this is what normal looks like now. Meanwhile, the median household income in America is about $84,000. Let that sink in. We're asking households earning $84,000 a year to buy homes priced at 6 times their annual income. Historically, that ratio was closer to 3. If that feels insane to you, congratulations, you're still connected to reality. But here's where the system starts whispering lies. The bank says you're approved. Your parents say they did it on one income. TikTok says house hacking solves everything. So you assume the problem must be you. It's not. The problem is that affordable has been quietly redefined and nobody told you. Let's start where most dreams die, the down payment. The old standard was 20%. On a $500,000 home, that's $100,000 in cash. The median American savings account? Roughly $8,000. That's not a small gap. That's a canyon. So people adapt. They put down 5% or 10%. And the moment they do, they unlock a special fee called PMI, Private Mortgage Insurance. This is the monthly penalty you pay for not already being rich. It typically runs $200 to $400 per month, and it protects the bank, not you. You're paying extra every month because the system doesn't trust you, yet it still happily takes your signature. That's not assistance. That's financial punishment dressed as opportunity. If this already feels uncomfortably familiar, pause for a second. Hit like if you've ever looked at home prices and thought, this math doesn't add up. Subscribe to Capital Misfires if you want real numbers, not motivational nonsense. Because next, we're going to break down the actual monthly cost of a $500,000 house, and this is where the illusion really collapses. You've probably already done this math in your head. If I can just get the down payment together, everything else will work out. That thought has quietly destroyed more financial futures than bad credit ever could. Because the down payment isn't the hurdle, it's the trapdoor. If you're still watching Capital Misfires, it means you want the version of this story that real estate agents never show you, the one where numbers don't care about motivation, vibes, or hustle culture. Let's start where the rule everyone pretends still exists, 20% down. On a $500,000 home, that's $100,000 in cash, not investments, not retirement accounts, actual liquid money. Now here's the problem. The median American savings account holds about $8,000, so you're not a little behind. You're roughly $92,000 away from what the system casually calls responsible. And before someone says just save harder, let's actually run that math. The median household income is around $84,000. If you somehow save 10% of your gross income, which most households never manage, that's $8,400 per year.
At that pace, it takes 12 years to reach a $100,000 down payment. That's assuming home prices don't rise, rent doesn't increase, inflation stays calm, and life doesn't happen. None of those things are true. So most people do what the system expects them to do. They compromise. Instead of 20%, buyers put down 5% or 10%. Sounds reasonable, feels accessible, is financially brutal. Because now you've unlocked PMI, private mortgage insurance. This is a monthly fee you pay because the bank doesn't trust you. It doesn't protect your house, it doesn't protect your family, it protects the lender. Translation: you're paying extra every month for the privilege of being slightly less wealthy.
PMI typically runs $200 to $400 per month, sometimes more. That's not temporary pain, that's years of money evaporating into nothing. And here's the part nobody tells you. Even after you escape PMI, the damage is already done, because PMI isn't the real problem. The real problem is what comes next. Let's say you scrape together 10% down, $50,000. Your loan is now $450,000. At today's interest rates, roughly 6 to 7%, your monthly mortgage payment lands around $2,750 to $2,850. And that's just principal and interest. No taxes, no insurance, no maintenance, no reality. This is where people mentally stop calculating, because if they didn't, they wouldn't buy. But we're not stopping. If this is already making you uncomfortable, good. That discomfort is financial awareness forming. Now we add the things that actually make the house livable. Property taxes, $4,000 to $8,000 per year. Let's be conservative, $500 a month. Homeowners insurance, skyrocketing due to climate risk, $250 to $350 a month. Maintenance, the forgotten killer. Rule of thumb, 1% of home value per year. $5,000 annually equals $417 a month. PMI, because you dared to be normal, $200 to $400 a month. Now, let's stack it. Mortgage, $2,850. Taxes, $500. Insurance, $300. Maintenance, $417. PMI, $300. Total monthly housing cost, $4,367. And that's assuming nothing breaks. No roof, no HVAC, no surprise HOA bill, just existence. Ask yourself this honestly. If my housing costs were $4,367 every month, would my life feel stable or constantly one expense away from panic? Because this is where the math starts telling a story culture refuses to hear. The down payment wasn't the finish line, it was the bait. The real cost of a $500,000 home isn't the price tag, it's the monthly obligation that never stops asking for more. What number scares you more, the $100,000 down payment or the $4,367 monthly reality? Tell me in the comments, I read them. Approved doesn't mean affordable. Here's the most dangerous sentence in modern finance. Congratulations, you're approved. That single word has convinced millions of people they're safe, right before the numbers prove otherwise. If you're watching Capital Misfires, this channel doesn't care what banks allow. We care what actually lets you live without financial panic. Financial advisors and banks both use rules, but they are not the same rules, and confusing them is catastrophic. Rule number 1, the safe rule, ignored. Experts recommend spending no more than 28% of your gross income on housing. Rule number 2, the bank rule, weaponized. Banks approve loans up to 43% debt to income. That gap? That's where stress lives. Let's reverse engineer reality. Your housing cost, $4,367 per month. If that equals 28% of your income, you need to earn about $187,000 per year. Now let's be generous and use the bank's 43% threshold. You still need around $150,000 annually. Let that sink in. A $500,000 home quietly requires an income most households will never reach. This isn't pessimism, this is arithmetic.
Only about 10 to 20% of U.S. households earn $150,000 or more, which means 80% of households cannot comfortably afford a $500,000 home under any sane financial standard. Yet, people keep buying. So who are they? Dual-income professionals in high-paying fields? Buyers with family money? Or people stretching themselves so thin that one surprise expense detonates everything? Most fall into that last category. And here's how this collapses. Let's make it painfully real. Meet the Johnsons, two professionals, stable careers, combined income $160,000 per year. By every social standard, they're winning. So they buy the $500,000 house. Here's what happens next. $160,000 sounds massive until taxes take their cut. After federal taxes, state taxes, FICA, and modest retirement contributions, their take-home pay lands around $9,500 per month. That's the real money. Now subtract housing. $9,500 minus $4,367 equals $5,133. That's what's left to run an entire life. Let's allocate it. 2 car payments because suburbia, $800. Car insurance, $250, gas, $300, student loans, $600, health insurance premiums, $400, groceries, careful, not fancy, $800, utilities, phones, and internet, $450, remaining balance, $1,533, and we haven't touched clothing, medical copays, car repairs, kids' activities, emergencies, real savings. This household is now spending 46% of take-home pay on housing, not 28%, not safe, just survivable for now. If this breakdown feels uncomfortably familiar, you're not alone. This channel exists for people who feel like they're doing everything right, but still falling behind. Here's the part spreadsheets don't show. It feels like checking your bank balance before groceries, saying no to a $35 school trip just in case, praying the check engine light turns off on its own, delaying medical appointments, financing repairs that used to be emergencies. One broken HVAC? That's a crisis. One job disruption? That's disaster. These aren't reckless people. They're normal people trapped by abnormal prices. Pause for a second. If a household making $160,000 feels this fragile, what happens at $120,000, $100,000, $84,000? That's not tight, that's impossible. Approval isn't validation, it's a liability transfer. The bank gets interest, the agent gets a commission, you get anxiety. Have you ever been approved for something your gut told you was a bad idea? Because we expose how being house poor became normalized and why society gaslights you into thinking that misery is maturity. Somewhere along the way, we stopped calling this financial stress what it is and started calling it adulthood. If struggling to afford shelter feels like a rite of passage, something is deeply wrong. Let's go back to the Johnsons. They survived month 1. Month 2 felt tight. Month 3 required sacrifices. Then real life showed up. The car needs brakes, $800. Credit. The AC dies in July, $3,500. Financed. A few months later, one income dips, reduced hours, missed bonus, delayed raise. Now they're short $600 every month. There is no emergency fund. There was never room to build one. This is the exact moment people become house poor, not on move-in day, but when the first surprise hits. House poor doesn't mean reckless spending. It doesn't mean poor planning. It means your housing costs dominate every decision. Repairs become debt. Emergencies become panic. Savings become optional. Rest becomes impossible. You technically own a house, but functionally, the house owns you. And here's the twisted part. We've normalized this. Listen to how society frames this. Everyone's house poor at first. That's just part of homeownership. It'll get easier eventually. At least you're building equity.
We've rebranded financial fragility as maturity. Can't afford furniture? You're just starting out. Eating ramen to make the mortgage? You're disciplined. Stress headaches and insomnia? That's responsibility.
No, That's a system forcing people to survive instead of live.
If you've ever felt ashamed for being stressed about money after making it, this channel is for you. Your parents bought a home at your age, but here's what nobody finishes saying. Their house costs 2 to 3 times their income. Yours costs 6 times yours. Same word, house, completely different math. Your friends are buying too, but you don't see family help, silent debt, empty retirement accounts, panic behind closed doors. Instagram doesn't show anxiety. You've heard this one. Renting is throwing money away. But being unable to afford your mortgage is also throwing money away, just with penalties, interest, and foreclosure risk. At least rent doesn't trap you. At least rent doesn't demand $5,000 on a Sunday night. At least rent doesn't pretend stress is success. Here's your permission slip. You do not have to buy a $500,000 house to be successful. You do not have to stretch until your life snaps. You do not have to participate in collective financial denial. There is no trophy for suffering quietly. Ask one question. Who benefits when you buy? Banks earn 30 years of interest. Agents earn commission. Insurers earn premiums. Municipalities earn taxes. Who benefits when you don't? Nobody except you. That's why nobody encourages restraint. Be honest. Do you think being house poor is just normal now, or a warning sign we're ignoring? Because I am about to break the illusion completely, what real wealth actually looks like, and how to stop confusing approval with freedom. Let me say something that sounds wrong, but isn't. Buying a house you can barely afford does not make you wealthy, it makes you fragile. If you're still here, this is the part that actually matters. We've been sold a very specific idea of success. Own a house, pay a mortgage, repeat for 30 years. Call it stability. But here's the part nobody emphasizes. You don't own that house. The bank does, for decades. And if missing one payment can threaten your entire life, that's not security. That's leverage pointed at your throat. Real wealth isn't granite countertops or square footage. It's margin. Margin in your budget. Margin in your time. Margin in your decisions. Real wealth looks boring. It looks like being able to invest consistently, handling a $5,000 emergency without panic, not choosing between repairs and retirement, sleeping without doing mental math at 2 a.m. Real wealth is freedom, not equity you can't access without selling the roof over your head. And yet, the financial industry keeps telling you the opposite. Why? Because they profit when you buy, not when you think. Banks profit from interest, agents profit from price, insurers profit from risk. Nobody in that chain benefits when you say, "This doesn't work for me." So they don't encourage that decision. They normalize stretching. They glamorize struggle. They reframe anxiety as ambition. That's not advice, that's sales. Here's the blunt version. If you're looking at a $500,000 house and your household income is under $140,000, stop. Not slow down, not run the numbers again, stop. You are about to make a decision that will dominate the next decade of your life. I don't care what the mortgage broker approved. I don't care what's normal in your market. I don't care what your friends did. The numbers don't care about social pressure. People always think they'll be the exception. They assume raises will come, side hustles will scale, everything will work out. Sometimes it does. Often it doesn't. Then one expense hits, then another. Then stress becomes permanent. And suddenly the dream house becomes a financial cage. I'm not saying give up on home ownership forever. I'm saying give up on the illusion that approval equals affordability. Maybe you wait 5 years, you choose a smaller home, you move markets, you keep renting and investing. All of those are valid. There is no prize for being house poor. There is no medal for suffering quietly. So ask yourself this, honestly, will this house improve my life? Or will it just convert my income into stress and interest payments? That's the question banks never ask. If this video helped you see the system more clearly, like the video. It tells the algorithm this math matters. Subscribe to Capital Misfires if you want more breakdowns like this.
business failures, money psychology, and the systems quietly shaping your life. And comment below, approval isn't affordability, because sometimes the smartest move isn't playing the game better, it's recognizing when the game is broken. The end. I'm Jimmy. This is Capital Misfires, and now you know why capital fails, not by accident, but by design.